let's run a discounted cash flow model on Boeing. Now, Boeing is usually in the news a lot. It's a big company. The stock has dropped a ton. I mean, I owned it. I sold it a few months ago, not at the peak, but way before it dropped. So let's see. So just because the stock goes up a lot or down a lot, that doesn't necessarily mean it's a good or bad buy. You have to look at the fundamentals, the financials, to get a sense of how the company's doing. And then you have to estimate the future, of course, which is the hardest part. So they have $77 billion of market cap, $137 a share. That means they have 564 million shares outstanding. So we have to figure out the future free cash flow and discount that back to today and divide that number by 564 million to get the estimated stock price and to see, based on the numbers, if it's a buy or sell. So the free cash flow is the best number to look at because it's actual cash that goes in and out of the business after operations. And the good thing about free cash flow is it can't be manipulated by accounting. On the income statement and the earnings, those numbers can be manipulated. At least in the short run, they can. In the long run, it should all equal out. But different depreciation methods and different amortization methods and losses and things like that can change the value of net income a lot. So we have the free cash flow. As you can see, it's all over the place. It went from 7 billion to 11 billion to 13 billion down to negative 4 billion. Also, net income is also a little bit all over the place. Revenue should be the smoothest, but they had a big drop in 2019, 25% drop. So it's not a great sign when you're investing in a company and the most prior year they had a big drop in revenue, they lost money, they had negative cash flow. But it's Boeing, it's a big company, and they could sustain negative times, especially coronavirus. They have the capital. So we have the future estimation of the company. Now let's see our discount rate. So what's the interest expense that they pay on the debt? 722 million. And let's see how much debt they have. So short-term debt is 7 billion. Long-term debt is 19 billion. That's debt due more than a year, long-term. And they pay a pretty low interest rate on the debt, 2.67%. But we have to reduce that by the effective tax rate. So let's get the income before tax on the income statement. And Yahoo has all this information, so I don't have to go to the 10K and sift through it. It's a negative year. Let's pick a last year. The effective tax rate should be pretty similar year to year. Let's pick a. Looks like it's really low this year. Let's pick 2017. Get a good estimate. That's a hard thing because when you look at the income statement, there could be a year where they took a big loss. And then so it skews the numbers a little bit. 18%, that looks right for effective tax rate. So even though they pay 2.67% on the debt, you have to discount that a little bit to 2.18%. So that's the cost of debt. And the cost of equity, we need the beta for that. Beta is the volatility of the stock, 1.45, a little volatile. So it moves 1.5 times the market. So the cost of equity using the CAPM model is 13.5%. And when you combine the cost of debt and the cost of equity, you get 10.53%. And the way we combine it is we use the weight of debt and the weight of equity to get that 10.5. And then we discount the future free cash flow that we estimated in right here, and we did a terminal value at the end to get a final estimation, and discount it back to today's dollars. And the present value of the future of the company is $107 billion. And when you divide that by the shares outstanding, we impute a stock price of $190. And that is more than the actual stock price of $137. So you could say it's trading at a discount, a 28% discount. And this is the historical stock price the past 5 years. And you can see it was over 400 at one point. What was that, in 2018, end of 2018 maybe? And then it was pretty strong for a few years, plus 300 a share, until it dropped off a cliff like everything else did in March when coronavirus hit. And it's pretty much been wavering around that point for a few months now, in the low 100s area. So it was trading at a premium to intrinsic for a while, and now it's trading at a discount. And people don't always look at the past, they look into the future too. So they're thinking, what will be the future of this company? And that's why maybe it's trading lower. So you have to make that estimation yourself, which is, I know, really challenging. What will the future of the company be? A company like Boeing. But I hope you liked the video, and let me know in the comments what you thought. Thanks for watching.